I'm calling this the Mainstreet Fairness Act because this will even the playing field for our local businesses who are required to collect the sales tax on goods where the internet companies are not. House Bill 278 will give Missouri the means necessary to collect the taxes that are already owed on remote sales or out-of-state internet sales. I see the problem illustrated, or I saw this last holiday season when I went to the stores. They were full, cram full of consumers ready to purchase goods right after Thanksgiving on Black Friday. It was the best turnout of consumers in 3 years. And when an analysis was done of that weekend, basically what they found is that the sales on that Friday after Thanksgiving were a little less than what they had anticipated. But when they looked at internet sales, they were up 6%. And that tells me that what was happening, consumers were going into stores, looking at the merchandise, trying on the clothes, whatever, and then going home and purchasing them on the internet. And in my mind, that was not a time-saving thing because it would have been much easier just to purchase it there at the store. But it was indeed, I feel, an effort to save the sales tax. This is undermining our local businesses by having this sort of the tax is owed on all those internet purchases. We just don't have a mechanism for collecting it right now. Our brick and mortar businesses are the mainstay of our community. They are the backbone of our community. These are this is where the majority of jobs in Missouri come from. The people who work in these brick and mortar businesses and the owners are they coach our little leagues, teach our Sunday school classes, they belong to Rotary, and they are the backbone of our community. And we as a legislature owe them the right to make the playing field level. We are not trying to make one business group more advantaged than another, and currently that is the case. Earlier this week I sent you some information about the bill itself, and you have that at your desk right now. The bill is 104 pages, so and not the most enlightened reading or in the world. So I just want to real quickly review with you. The first 46 pages of the bill basically establish who implements the agreement and the dates that things are to start. If you have if your municipality annexes a subdivision, then that municipality will collect more taxes from that particular annexed subdivision. So this tells when that date will, when that will start to happen. The next set of section 47 to 60 are definitions, and you have on the sheet a list of the different definitions. This will put Missouri in line with the definitions that the 24 states that currently participate in the Streamlined Sales and Use Tax Agreement have. And so Missouri is making law more uniform and simplified to do that. And then the last pages basically talk about the bill. This bill is voluntary for internet companies. A lot of people ask, why would any company want to do this voluntarily? And they do want to do it because they get to keep 2% of what they collect. For the large internet companies, this is an incentive, and I have witnesses that'll tell exactly the number of companies that participate, but it's over 1,000. The software that is used to produce or to calculate this is, it can be subtracted from the amount of money that is remitted to the state, so it is no extra cost for the service. And then another thing that companies who participate seem to like is that they are relieved of the liability of collecting and remitting those taxes if they use the certified provider system or the certified automated system.
I'll tell you a quick story. I was elected to the Iowa House of Representatives back in 1992. Sat down for the first time at my desk in the House chamber in 1993, brought in a laptop. Back then in 1993, you got to remember laptops were about 20 pounds. This is what I'm traveling with today. Back in 1993 was also a memorable time because that was the year the United States Supreme Court took away the ability of state legislatures to collect the sales tax on goods that were purchased out of state. Took away our remote tax collection authority. It was all due to the Supreme Court case Quill versus the state of North Dakota. And the United States Supreme Court told state legislatures at that time, your tax laws are too complicated. It's an undue burden for remote sellers to have to figure out what the tax rate is in 7,500 different taxing jurisdictions. Supreme Court told state legislatures around the country that there is a path to get that remote collection authority back. First, you need to simplify your definitions. You can't say that it's a food in one state and it's not a food in another state. You can't say that this is a digital good. Of course, back in 1993, we didn't have digital goods. But you can't say this is a tangible personal property in one state, but it's not tangible personal property in another state. You have to unify your definitions. And then you have to go to Congress because it's interstate commerce, and they have to bless your agreement. And so after that, the National Council of State Legislatures and the National Governors Association started working together to try to figure out how do we address Quill versus North Dakota. And what they came up with is called the Streamlined Sales Tax Compact. Today there are 24 states, Iowa being one, we passed in Iowa when I was Speaker, Georgia being the most recent state, they passed it last spring during part of their budget negotiations. You have 24 states today that have done that. We've come together to agree on essentially what our definitions are of taxable goods and services. It's the authority still resides within every legislature about what they want that tax rate to be. The authority still resides within every legislature about whether they want to make something taxable or not. If you choose to tax food, that is your business in Missouri. If you choose to tax clothing, that is your business in Missouri. And whatever rate you choose to tax it at is also your business in Missouri. But we asked to join the Streamlined Sales Tax Compact that you unify your definitions of whatever a article of clothing is, whatever a food or a snack or a candy item is, with the other states that have adopted this so far. At the time, in 1993, one of the reasons the Supreme Court struck down state tax laws was because there wasn't a mechanism for a retailer to be able to figure out what the tax rate is in those 7,500 taxing jurisdictions. That is no longer the case today. You're going to hear from a witness who actually runs one of the software companies that has the database that plugs into someone's electronic shopping cart. With a couple clicks of the mouse, that problem has been solved. Retailers all across the country, your major big box stores, that not only have stores in your state but also transact business online, have the software today to know what the tax rate is if you make a purchase in Iowa from Missouri, or if you're an Iowan and you purchase something from someone in Texas. The obstacle that existed in 1993, which was the database problem, has been taken care of. It's no longer a problem for states. The ultimate issue that confronts state legislatures today is whether or not they want to have a tax policy that benefits out-of-state businesses at the expense of the local bricks and mortar merchants. The folks that are paying commercial property taxes, hiring people, paying unemployment comp, workers' compensation, the associated costs of operating that business in addition to supporting the Little League team or supporting the cheerleaders. Those are the folks that are at a competitive disadvantage because states give a break to out-of-state companies that are selling goods and services into into their own districts, into their own state. That's why you find in this year a dozen different states that are looking at joining the Streamlined Sales Tax Compact. States are recognizing that their tax policies create an unfair advantage for out-of-state companies, and they're recognizing that they're hemorrhaging tax revenue. Local governments in particular that are dependent upon sales taxes or property taxes are standing up and saying, if we're continuing to lose sales tax revenue to these out-of-state businesses, that puts a greater and greater pressure on our property taxpayers. It's too often tax policy, at least Mr. Chairman, in Iowa, tax policy is like a balloon. If you push it on one side, it's going to push out on the other side. And when you lose sales tax revenue, your local governments don't have any other way to collect it. I mean, most of them don't have an income tax. That leaves them only property taxes. Maybe your property taxes here in Missouri are low. In too many states, they're high. And so you have local governments that are starting to say, we see the writing on the wall. We can no longer ignore a loss in sales tax revenue because it's going to mean that property taxes have to go up as a result to continue to pay for those services. So you're finding cities and counties across the country that are coming to their state legislature saying, you have to address this problem because it's inevitable. It's only going in one direction. Today, according to a University of Tennessee study, the state of Missouri is losing out on $430 million in sales tax revenue that is owed, but is not being collected. It's a combination of business-to-business transactions, business-to-consumer transactions, on the internet, and also through catalog and typical sales forces that are out there. $430 million that aren't being collected today. I would encourage the good legislators in Missouri that before you start making decisions about your budget or fees or fines or other taxes or other cuts, you consider about whether or not you want to collect part of that $430 million that's owed.